South African households suffered a collective shock when the Reserve Bank shocked them with the steepest repo rate hike in over 2 decades. Others are saying from 4.75% to 5.5%. This came against widespread unease about rising cost of living and transportation. The Reserve Bank highlighted fast-rising inflation as its key focus to protect consumers from future shocks. But some observers believe we could do things a little differently. Joining us now to share his views on why the bank has to make some critical changes in its economic modeling is academic and former statistician general, Dr. Pali Lehohla. Dr. Pali, good evening, and thank you very much for your time and for joining us tonight up here on In Focus. Others would maybe say the Reserve Bank was signaling very strongly that it will remain ultra-orthodox in its approach to inflation, that it is not going to relinquish this idea that it wants to manage inflation and keep it at a 3 to 6% target zone. Is that 3 to 6% target zone just a number? Is it significance? What's the significance of keeping the inflation there?
I think inflation has to be managed, but in its management, it has to take into account whether there is economic growth and there is unemployment that has to be tackled. So, in absence of those two, then the inflation targeting doesn't serve any purpose. So the question really for me is, looking at the past 24 years, the real interest rates have been above the rate of growth in 18 of those years. Now the question is, in those 18 years, were we concerned about growth or were we concerned about inflation target? Was the policy stimulating growth or was it stimulating protection of the currency at the expense of growth? And this issue is an issue that has to be contested, not only by the Reserve Bank, but by the Treasury and by the economic sector of the government. Left to the Reserve Bank alone, then we end up with a situation, an anomaly of 18 years out of 24, where real interest rates were higher than GDP. And those have very many implications, because once we increase interest rates and we don't stimulate industrialization, those who look at hot money will invest in the money markets and then will financialize the economy and undercut your own industrialization strategy. So without an industrial bank and the Reserve Bank helping that industrial bank to work, then we have created this situation that we have, where we have de-industrialized and financialized. So the financial sector is 24%, and the manufacturing sector is about 12%, having dropped from a high of 24%.
Yeah.
And unemployment soars. So our own policies are leading to playing into the hands of the markets of hot money.
And in that scenario, will things get worse before they get better, or will get worse before they get even more worse?
I don't see an industrial policy that is talking to finance in a manner that inspires a reduction of interest rates for those who are in manufacturing. So to invest, you need to secure cheap money. And it cannot be money where interest rates are as high as they are in South Africa. And if then we have to raise, ensure that we stop, we protect the value of the rand at the expense of manufacturing, at the expense of employment, then we have this kind of serious problem where 18 years out of 24, we have a situation where real interest rates have been above GDP growth. So the question is, if GDP growth, which implies that it's an increase in the wealth of the nation, is not our target, and the experience that we have in terms of the economic trajectories, yes, we actually prioritize interest rates that are higher.
So if the central bank
kill manufacture.
If the central bank doesn't consider then the expectations of players in the economy and what inflation will have on that, what other tools do they have? What would they need to be looking at?
The tools that the other reserve banks have is a dual mandate. Growth and managing the value of the money, or employment and managing the value of money. If you give it only one mandate of managing the value of money, then they leave these others to run helter-skelter, and there's nobody who is watching that and taking care of that. That cannot be a sound policy. It can't be. Because it yields this situation where out of 24 years, 18 of those years, real interest rates have been higher than real GDP growth. So in terms of that, then you have betted on uneaseization. That's all you have betted on over this period. So the economic policies that are said to be sound cannot be sound if they generate those kinds of outcomes.
So what would be the outcome then? What would it help if, like the U.S., we see an inflation running at 9.1%, if the central bank loosens its monetary policy? But we still, if former President Thabo Mbeki is to be taken by what he said at the memorial of Justice Duarte, don't have a plan to steer us out of poverty coming from government. So you'll have a central bank that's just letting inflation run amok, but there's no plan on this side.
I mean, you cannot allow inflation run amok. Certainly you can't do that. One is not advocating that at all. But at the same time, you can't allow interest rates, real interest rates, that are totally above the GDP growth. You know, when the real interest rates dipped below GDP growth, it was only in 2003 to 2008, and another year thereafter. All these other years, this real interest rates have been above that. So if that's the structure of the economic policy, and it inspires that, then you can never grow. You will grow by chance, and that growth will disappear. And what will happen, basically, is that we will financialize the economy. You will deindustrialize, and that's what we have seen, because you will attract only hot money. That comes and leaves the country as quickly as it can. So everybody will play in the financial markets. So what we see is by design, it's not by accident. So our policies must be designed such that they actually achieve the intended, not the extorted intentions, but the intended intentions. They have to be in the plan. And the former president is correct. There's no plan in the country. It's just rotations.
Let's take a break. We'll come back with Dr. Pali Lehohla in a moment and expand on that a little bit more as he reflects then on the latest decision taken by the Reserve Bank to raise the repo rate by 75 basis points. In Focus continues shortly. Back with you tonight and looking at some of the decisions taken recently by the Reserve Bank, and Dr. Pali Lehohla making an argument that there needs to be some critical changes to the structure of the Reserve Bank and how we use the monetary policy, and arguing that it should indeed have a dual mandate, not only that of looking at interest rates, but also of ensuring that there is, of course, a possibility to ensure that those interest rates stay low. And we attract investment for industrialization so that we can build firms and get the economy growing at a much higher GDP than it is currently doing so. So if we look then at the decision of the Reserve Bank during the time of COVID-19 to lower those interest rates, because they were quite low during that time. We know that there was very little movement as far as production in the world, in the global markets and everywhere else. What was achieved by that?
You may lower interest rates, but if you don't have an infrastructure that encourages investment, and you don't have an infrastructure that encourages manufacturing, that your coal has to be shipped as quickly as possible to markets that buy this coal at higher prices, you're not going to invest. So in the absence of that architecture that is well designed as a plan, Reserve Bank can set interest rates at zero, probably. There'll still not be any investment. What I'm arguing is it cannot be that economic development and employment are left to their own devices, and they are not under a strong articulation, as is the Reserve Bank in as far as monetary policy and inflation targeting is concerned. You've got to target inflation as well as you target employment and you target industrialization with the same rigor, with the same size of tools, with the same competencies. So, yes, they could be zero and sub-zero, but we wouldn't see a lot of industrialization because industrialization requires patient capital. And if you don't have the space for patient capital, you'll not actually achieve this. So, as we go into the policy conference of the ANC, these things are not there in the documents. So you have a monetary policy that is really the tail is wagging the dog, which is what is the economic development trajectory that South Africa intends to have.
Yeah.
Monetary policy surely has a role. But when there isn't as much rigor in the other space, then it will be a poor cousin. And we have seen poor cousin employment and industrialization. So a richer cousin is financialization. And in fact, they have even bigger cousins elsewhere in the world.
So, Dr. Pali, looking long term then, if, for example, the Reserve Bank, others are saying this is a good decision, it will be able to at least bring down average inflation down to around maybe 5% if we are, and we'll probably see only that in 2023, 2024. Once we get there, if you're chairing the subcommittee on economic development within the African National Congress, and we are assuming that they'll still be in power at that time, what would you suggest then would be the thing to do?
The thing to do is to allocate responsibility for either economic development or growth, economic growth, as well as inflation targeting or economic growth and employment, as is the inflation targeting to the Reserve Bank, to manage all those three at the same time. And be as rigorous, and they have to be measured on that performance. Second, it is really very difficult to expect that the 6 persons or 7 persons who make these decisions are all employees of the Reserve Bank under the same governor. That relationship is incestuous. I mean, if these things get voted for, that there is a technical argument for them, and in the end, on the basis of the technical arguments that are on the table, there is a voting, then it can't be left only to the people in the Reserve Bank. It means that there are possible technical arguments worthy of voting on well outside the Reserve Bank. And it can't be left to the Reserve Bank because that relationship is incestuous. They cannot rebel against their government. Perhaps the governor is open and everything, but it is not a relationship that is without fault. It has to be above board. So you need if there are 7, you need 3 from outside the Reserve Bank and 3 from inside the Reserve Bank. And these other 3, one must be from Treasury, another from Economic Development, and another one from Labor. And they must be competent. and then the voting by the policy, MPC, the governor must have a winning vote in the event that there is a tie.
Yeah.
But that system is not transparent. It might be transparent in terms of the guys working there, but it cannot not be trusted to be transparent. If you audit it, you'll see that it doesn't yield the transparency.
Yeah.
It's incestuous.
Others might argue that then you are now bringing political influence into the South African Reserve Bank, depending on how you're seeing it. I mean, others are saying politics are already there, but others are saying it's quite independent at this particular point.
I don't know, it's independent, but when it comes to voting on those things and making technical arguments, the Director General of Treasury must be technically competent, given the mandate of sorts to ensure certain things. The Director General at Economic Development must be equally competent. We are not saying bring the politician, bring a Director General there who is competent to argue for this particular processes. And the Director General of Labour must be there.
Yeah, yeah.
And then they must sit with their counterparts and argue on these things. I'm saying the design of this thing is fundamentally wrong. It's faulty.
So the argument that the monetary policy makes that, well, our decisions continue to be data dependent and sensitive to the balance of risk to outlook, you're saying are not well informed if they don't consider data that's coming from the DG at Treasury, that's coming from DG at Labour, who is looking at creating employment in the country, or DG at Economic Development.
You know, when I presided over Consumer Price Index, there was no voting. It is a consumer price index. That's the number. But at the MPC, you introduce voting, which means that there are policy options that you should vote on, and they are informed by political processes, by development challenges, and by development prerequisites. What I'm saying is, in a process where you have to vote, it can be a vote that is undertaken by people in the same institution, under presided over by their governor. That can't be. So it can't be. It's incestuous. There's conflict of interest.
Yeah.
Right from the beginning. You need to have 3 people from outside who are independent, who are competent in their own field, and can make a competent policy option on the table. It will be backed by facts, and then these policy options, contested as they are, then can be subjected to a vote.
How do we...
You cannot subject to a vote something that is a policy under the same roof.
Yeah. How do we foster then that partnership? Because from what I'm sensing, then there needs to be a vision that comes from the economic cluster in government that then informs the Reserve Bank, if we are indeed to extend its mandate, not to just only look at looking after the price, but looking after employment and industrialization. So they need to be a way in which they talk to one another.
Look, I mean, the governor of the Reserve Bank has said in increasing the repo rate, overnight repo rate. By increasing the repo rate, there are implications. I do not know how their modeling works, but I would hazard, given if you regress this over time, over 24 years, there is no doubt in my mind that an increase in the interest rates has had an impact on economic growth, and a negative impact. So it cannot be that an interest rate hike is insulated from its impact on economic growth. And that's why I'm saying, to the extent that interest hike has the possibility of impacting economic growth, because that's a decision that has indigeneity in it. Unless interest rates are exogenous to real growth of the economy, there's indigeneity, and one has to actually have people protecting the effects of that indigeneity implication on interest rate, on growth rates. If that is left to the Reserve Bank, whose mandate is to protect interest rates exclusively, then there's nobody speaking on behalf of economic growth, nor unemployment. At the very least, there must be people from outside who would come and articulate those issues, even if the Reserve Bank doesn't have that mandate. But for them to have exclusive supervision on interest rates as though they are exogenous to real growth rates, then it's really a policy disaster of magnitudes.
Is that your forecast even for the future, a policy disaster of magnitudes? I mean, what is the likely path that
if we sustain this, then growth will come by luck, and it will gallop, as luck always gallops out of sight.
Dr. Pali Lehohla, appreciate your time. Let's leave it there for today. That is the Statistician General, that Dr. Pali Lehohla is saying growth will come by luck if we continue on this trajectory. Well,